Guys, John Polemy here, Actionable Intelligence. Today is Saturday, August 9th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I'm not a registered financial advisor, and I cannot give you individual investment advice. Please do your own due diligence. It's your money. It's your responsibility. Okay, just a little news here. This video is a little late. I was having internet trouble earlier in the day. Sometimes that happens down here in South Texas. So better late than never, I guess. I also wanted to talk about next week. I'll start putting out the reality check on Rumble. I'll let people know via Twitter and on this YouTube, sending messages out when that's available. So if you're inclined and you like that reality check stuff, we'll start doing that next week. Okay, first slide here is from Goldman Sachs. It says U.S. equities turned speculative in second quarter 2025. High momentum and lower quality groups rallied most following the Liberation Day market lows. And you can see that the S&P and the NASDAQ, how much they've rallied just since Liberation Day, basically 4/8/25 to the end of July, and you're up 38% in the NASDAQ. But if you look over here, unprofitable tech, AI, most shorted stocks, meme stocks, ARK Innovation ETF, and Bitcoin sensitive stocks, these things are up tremendously more. So basically, near the end of a bubble, this is what you start seeing is everything just starts going up. It's a melt up. Garbage stocks even go up. And so that doesn't mean that we're going to have next week a crash or it's the end of this cycle. It just means that we're getting closer. It's just another metric that's showing you how speculative this market really is and how out of control it is. So this is uh this is not positive. So I want to get into oil. Obviously, there's a lot of news. I'll have some other slides here coming up. We've talked consistently on this channel for months now, various oil company CEOs and managements talking about rising costs in the Permian, exhausting tier one locations, and just the fact that at the current price deck, they're just not going to continue to drill new wells. And so the drill baby drill scenario is off the table at current oil prices. I think WTI is around $63 a barrel, and it's just not sufficient to get the necessary returns. And so we've seen um, drilling rigs stacked, frac crews taken out of the field. And I think this is kind of where we're heading, I think, because of that, because of the lack of investment, because these lower prices are causing new drilling to stop, new development to stop. And because of the characteristic of the shales that they deplete so quickly, if you don't have this Red Queen's race, if you will, constantly running to replace production, notwithstanding the fact of trying to raise production, it takes more and more wells and more activity. And so it just doesn't make sense at these prices. And so on the left, you have Rystad. On the right, Wood Mackenzie. These are two consulting firms that talk a lot about supply and demand in the oil markets, do forecasting. Forecasts are notoriously all over the place in the oil market, but I want to give you a view of what could happen to non-OPEC supply growth from two of the top analyst groups. And without new wells being drilled, we're going to see non-OPEC growth go down. Now, there'll be a little bit of a surge here, a little bit in 2025 because some new projects are coming online in Brazil and in Guyana, but it's not going to be sufficient when you're running 105 million barrels a day of demand. A 500,000 barrels here, 1 million barrels there. And then I think the other thing that people are not paying attention to is, yes, I understand that OPEC's made a lot of noise about reversing their voluntary cuts, but how much of that is smoke and mirrors and how much is actual barrels? And I think that I personally would never trust the OPEC members. They're notoriously opaque. They, quite frankly, are not truthful, and they have an agenda. So just because they say they're bringing production back on doesn't actually mean they're able to do that. I don't think the excess capacity that they have or people think they have is actually what they have, but that remains to be seen also. But there's definitely over the next couple of years going to be a challenge to non-OPEC supply growth if prices stay where they're at. We have people talking about $50 a barrel oil. I mean, that would just exacerbate the rebound and the higher price that you would see down the line. So this is from the Federal Reserve Bank of Dallas. They put out this information quarterly. This is a survey they did about break evens, if you will. Um, and you can see the different shale plays, Eagle Ford, Permian Midland, Permian Delaware, Permian other. These are the bands. So, and this is the mean, right? Line shows the mean and bars show the range of responses. So basically, if you look across this, and I just said WTI is at 63 and change, no one's going to drill wells when you're basically at break even. Okay. And that doesn't even include the cost of capital, all the other things. It just doesn't make sense. And so, because shale, obviously, I'm going to reiterate this, and everybody knows this, is declined so quickly, you're going to start shutting things down. It's going to have an effect on future supply. Therefore, setting the foundation for the next bull market in oil prices. Here's another company, EOG. There's a quote from them. U.S. shale doesn't have incentive to grow at current prices. So that's one of your major players is EOG. And so they're just telling you this is on top of several other companies that have said the same thing. So much for drill, baby, drill. Of course, we've been saying that for a while here. And I think it's finally sinking into the market. And I think as the market digests this reality, it's going to start pricing in, especially if OPEC disappoints on the supply side, you're basically volleying tennis ball back over the net to the OPEC, and they're going to be able to control prices now. Do they really want to see oil prices at $120 a barrel? No. They would like to see things, I think, in the 85, a band between 80 and 90, because in that band, they make a lot of money in cash flow, but it doesn't necessarily throw their customers' economies into recessions. I think that we're probably going to see higher oil prices. Again, we've talked about this many times. Demand growth is relentless and depletion is relentless. And we've had tremendous underinvestment. I believe I heard Rick Rule say recently that the global oil market has a spending deficit of about $1 billion to $2 billion per day. Okay, these are extractive industries. If you don't replace the barrels that you pump, at some point you go out of business. We have not been replacing the barrels we've been producing. At current supply or demand of 104, 105 million barrels a day, that's 37 billion barrels plus. We haven't found 37 billion barrels in reserves in probably decades, a couple decades. I'd have to go back and look. There's a chart out there, but we haven't been finding that. And so where is this new oil going to come from? What's going to temper the rise in demand? Will have to be price. And this is why I'm such a bull on Canadian oil sands. They're very cheap. They have long life reserves. Their ability to cash flow and make a profit is down in the low 40s, and they have decades of reserves. And that gives you the optionality on the upside. And what are they doing? They're not going to go out and build new projects. They're not going to spend billions of dollars. They're past that. So you have these assets sitting there producing. You just need to spend maintenance capital to maintain the project, make sure fix things, okay, keep it up to date. And then the rest is cash flow that can be used for what? The things that we like, debt pay downs, dividends, buybacks. That's exactly what a lot of those companies are doing. So this was a very important conversation that has happened in the last couple of weeks, or last week. U.S. shale has peaked, according to Diamondback CEO. I'll read this. Last quarter, we wrote a detailed letter that highlighted the macroeconomic environment and our opinion of the evolution of the shale revolution in the United States. The comments received significant attention, a lot of industry and investor support, as well as a healthy amount of pushback. Since the publishing of that letter, most of the macro uncertainty we discussed remains. We continue to believe that at current oil prices, U.S. shale oil production has likely peaked and activity levels in the lower 48 will remain depressed. The U.S. oil-directed rig count has declined by approximately 60 rigs this year, 59 rigs in the second quarter alone, and the Permian Basin active completion crew count has declined to around 70 active crews, down over 25% from 2024. Fortunately, the likelihood of a massive oil supply glut combined with an oil demand shock seems to have dissipated on the demand side. But the projected increase in global oil supply in the second half of this year is hard to ignore. Although projections are often incorrect in this sector, particularly when consensus is uniformly bullish or bearish, in this case bearish, we still believe we are approaching a yellow light to pull from last quarter's stoplight analogy. Therefore, we have set our business for the rest of 2025 to hold our oil volumes flat while cutting capex, maintain one of the highest drilled but uncompleted wells balances in the industry, and use free cash flow to pay down debt and continue repurchasing shares. This will allow us to maintain flexibility for a green or red light in the short term, but a green light is eventually inevitable given we believe current oil prices are unsustainable over the long term. So this reverberated through the industry within the news. And this is telling you what you know. This is not John saying this. This isn't some blogger or some opinion guy on FinTwit. This is directly from the CEO of Diamondback in the Permian. We've heard this now from multiple CEOs, EOG, Chevron, Diamondback, a plethora of other producers. No one is making money. It's look, you have a limited amount of drilling locations. Why are you going to break even on them just to do that? That makes no sense. And so again, you're going to see production in the U.S. go down. Now the test will be on OPEC, the call on OPEC. Do the excess barrels that they claim to have exist? We will see. And yes, there will be some increase. Some projects are coming online, some additional oil coming online in Guyana, like I said, in Brazil. But is it going to be sufficient to overcome what's probably going to happen in shale? I don't know how far it's going to drop off. We'll see. Here's a blurb from BP. Here's the CEO of BP. We think that demand and that supply from non-OPEC countries pretty much offsets each other, and therefore oil prices will be up to OPEC to decide where it goes. That was a recent interview. Says, I think we're seeing inline oil demand growth with what we've seen in the past. So about 1% demand growth over the past 20 years on average. This year, we're seeing 1%. Next year, we're seeing 1%. It comes from different places. It comes from the petchem side of the demand profile right now, petrochemicals. But we see demand in line with history, to be honest, despite all the headlines. And of course, there is additional supply coming onto the market. But we think that demand and that supply from non-OPEC countries pretty much offsets each other. And therefore, oil demand will be up to OPEC to decide where it goes, or the oil price, sorry. And then we'll just have to see how sanctions on Russia and sanctions on Iran play into that as well. So again, we've tackled one domino being this idea that we were just going to have this nonstop growth in drill baby drill in the shales because we've probably plateaued at best and possibly peaked, at least at this price deck. And now we're going to see attention shift to OPEC to see all these barrels are supposedly bringing back if they're in fact real barrels or just smoke and mirror barrels. Again, I like the oil sands because I make money all the way down to $40 a barrel. I see no with the only way I see oil going down to 40 and staying there is if you have a worldwide depression, deflationary depression that lasts for a couple of years. Otherwise, if oil prices stay in this range, even if they go down to 50, all it's going to do is make the inevitable rebound even greater and last longer. People forget this. It's not like, well, if prices go up, they'll just turn everything back on. When you get laid off a drilling rig, you don't just go home and sit on the couch and wait for them to call you at some unknown time in the future. You go look for another job. Maybe you go start building data centers, or you start working on a crew putting transmission lines in, or who knows what. And then when you get called back, you already got a job and you're thinking to yourself, well, do I want to go back to the oil field, work 20 hours a day, and then I know I'm going to eventually get laid off again? And what happens to the equipment when you lay it up? They don't like have guys in the yard that go around and do maintenance. They might do that for a little bit, but eventually you're bleeding cash. And so you stop doing any maintenance. And this is not good for rotating machinery and for, rust setting in and all kinds of other problems. You get to a point if the machinery sits there long enough, it costs a tremendous amount of money and effort to refurbish it and get it back online. And in many cases, you can't do it. It's not worth it. So the idea that, well, if oil goes up to 90 or 100, they'll just turn everything back on. Well, depending on how long it is, if it's a month or two, if it's 6 months, maybe, not if it's a year and a half. You've seen those stickers. Please, God, give me one more oil boom. I promise I won't screw it up again. It's a notoriously boom bust cycle. Here's Javier Blas, a guy I respect. He's a writer at Bloomberg. He's saying, this is paywall protected, so I didn't read it, but it says the headline, the bullish case for oil is real, but far, far away. Crude prices will head lower before any rebound. And so I think in this article, he even suggests they go down in the 50s. Again, I don't know if that's going to happen. I don't think it will, but if it does, they won't stay there forever. And again, that just gives me an opportunity. I mean, these oil stocks are already out of favor in trading as if this is going to happen. So if it doesn't, you're going to see a massive rebound. The sector that has performed worst in the last couple of years has been oil stocks, energy. So this is the sector I think that is, if you're a contrarian, if you're looking for a way to be a contrarian, this is the type of setup you're looking for. So this came from Rystad. This is global oil production on track for massive shortfall. This is something that the chairman of OPEC has been talking about and others in the industry because of the insufficient investment, not just in shale, but worldwide. Over the last 10, 15, close to 20 years, shale has sucked the energy and capital out of the room and caused prices to be lower and not incentivizing people to go out and spend the money on long-term high-cost projects, aka offshore. And so this is the daily production and demand scenarios in millions of barrels a day. So, you see basically, I mean, this is a problem. Now, of course, even as like the CEO of Diamondback said, making projections, especially about the future and in the oil industry, they're notoriously wrong. But this gives you a clue of what a possible scenario going forward. This would be bad for the world if this happened. Now, I think that there's a lot of oil and gas still in the ground. I'm not a Malthusian, and I think at a certain price it will be developed. But again, this is some of the arguments I have with people. You have to understand that how this works. It's not just happens. The price goes up to $100 a barrel and it magically goes away in 6 months. No, no, no. It's long lead times. Every day that goes by that we're underspending, the industry's underspending is setting the stage for the next price spike. So let's shift over to precious metals. A lot of times I get accused of just saying, well, you just talk about whatever's hot in the market right now. I've been talking about gold and silver stocks for a while. Silver now looks like it had already broken out kind of back in, if you want to say April, May timeframe, and then in June, then it kind of consolidated and then we're broken higher again. It's time to buy silver stocks. I mean, this looks like wow, this is a pretty big move already, almost 100%, but this is nothing of what's going to happen. I think you have confirmed breakouts, confirmed bull market in all precious metals. And, you don't go out on Monday and buy this after this run up from 46 to 54, 48 to 54. What you do is you should have your shopping lists and on pullbacks, you should be buying. That's what you do in a bull market. And so, um, that's what I've been doing. I haven't really added a silver stocks or silver stocks to the portfolio. I'm going to be looking to probably add a couple silver stocks, and also probably one or two of the mid-tier or junior gold mining stock, because it's time now. You'd see what's happening with over the headlines over the last earnings season, last couple of weeks with the majors. It's now time. You see the cash flows are being generated. It's now the time to migrate further down into the other sector, further down the market cap, uh, because that's where your 10 and 20 baggers are going to be. And so it's time to look for a couple of those. That's more speculative. There's nothing wrong with buying if you're somebody that has a lot of capital, there's nothing wrong about just building your own ETF. Buy, Newmont, Agnico, Eagle, um, Anglo Gold, and Barrick or something, and have four stocks, and you'll do very well. You know, you'll do two, three, four times your money probably over the course of this bull market. But if you want to take on a little bit more risk, then migrating down further down into the mid tier and into the juniors is where you're really going to get a lot of torque. So we're seeing this again, silver stocks breaking the new 52-week highs. Likewise, senior gold stocks, because of the earnings this week, they were tremendous. I mean, these people have so much cash now, they don't know what to do. And so I think a couple things are going to happen. One of the portfolio stocks that we have is the company that provides services to the mining industry, and they're starting to see their sales go up, because what happens when you get flush with cash? Okay, now we can start, you know, looking for additional metal. You start seeing some of the juniors and explorers, they're able to raise, in the past where they were able to raise $1 million on a raise, now they can raise 5 million. They can put more drill rigs in the field. So you're going to see activity pick up. The other thing I think you're going to see pick up is mergers and acquisition. Right now, a lot of the managements are talking like guys in the oil industry. Oh yeah, we're shareholder friendly. We're going to pay down debt and return capital to shareholders, yada, yada, yada. And I think they're sincere about that. But the urge to go out and buy ounces or merge or do an acquisition, I think is going to become irresistible, because the money is piling up so quick in some of these companies. They're going to have a desire. It's burning a hole in their pocket. They're going to have a desire to go out and want to do something, right? And so that could also be another catalyst for a move higher in the gold and precious metal mining companies, because once you start a mergers and acquisition, there has been a couple already acquisitions done here and there, but if you get into a full blown M&A kind of frenzy, then people start speculating on, okay, this company A got taken over. What's company B and C that could get taken over? And so we're not there yet, but I think we're going to be heading there, and that's going to be another big catalyst for the eventual move higher. I mean, you're in a generational wealth creating opportunity. This is akin to what I was talking about 5 or 6 years ago with uranium, where if you were along for the ride, the transformational wealth that was created. This is another opportunity here. Or when oil during COVID, during the pandemic, was, below, remember when it traded negative 47 and we were buying oil stocks hand over fist. These opportunities come along every so often. So, this is something that's a gold bull market, a real gold bull market. I've only experienced two other ones before this. This would be my third. I didn't have the necessary capital to fully take advantage of the last two, because I was a kid on the first one, and the second one I was not capitalized properly. Now I'm in a position where I can fully take advantage of this. Again, you don't have to run out on Monday and buy. You don't have to panic into this. Okay. These things are going to move up and then pull back, consolidate. That's just like a bull market, 2 steps forward, 1 step back. And so uh, be patient, layer into these things, but it's time to be doing this if you haven't already done it. I thought this was interesting. I like these ratio charts. I'm not making a big deal out of this. I'm just showing this a potential. This is the XAU ratio to gold price. And you see gold stocks have been falling relative to gold for 35 years. Well, not thir well, I don't want to say it's 35 years, but up until about 2016, then it kind of bottomed and you've seen a slight bias to the upside. Um, if this goes back to what we saw in some, historically, we could be looking at a move in gold stocks of, 500%. So I'm not saying that's going to happen. I'm not attributing anything to this. I just think it's interesting sometimes to look at these things. And this is true what this statement is here. Ratio charts are about relative strength. They compare the performance of one stock relative to another, and they are a useful additional tool for figuring out sector direction. So, you know, we have seen that underperformance of gold stocks relative to gold, but that is now changing. This is another indication that we're in a bull market when the mining stocks are doing what they should do, which is give you leverage to the gold price. Gold, physical gold, to preserve your wealth as a savings tool, gold mining stocks in a gold bull market to create wealth. That's kind of my view. So this was running around. This is from the Federal Board of Governors of the Federal Reserve. Put up here, U.S. to revalue gold, question mark. I'm not sure what they're going to do. I have no particular insight into what the Federal Reserve or Bessonette and Trump are going to do. Um, I do think that because of the fiscal situation and the debt situation and the limitation that the federal government's going to be that has right now and will continue to get worse as far as spending and debt and stuff like that, that I would not be surprised if they revalued gold. Gold's currently valued on the books at like 42 bucks and change. Okay. And so one of the things that's been said is, okay, you could revalue gold from $42 up to 3,300 or something like that, which it's around right now. And that would create this, you know, paper revaluation that you could somehow transfer to the Treasury's account, and then could be used to spend. And you've had other people speculate, well, then the Trump administration would buy Bitcoin with that. There's all kinds of speculation on FinTwit, but I don't put it past them because these governments now are getting backed into corners and they're going to use like I said, they have a complete bag of tricks and they're going to run through all these bags of tricks. And this is just from the note that was put out by the Federal Reserve. It said, with public debt at high levels, some governments have begun to explore financing additional expenditures without raising taxes while also not increasing public debt outstanding. One possibility is using proceeds from valuation gains on gold reserves as has been floated in the US and Belgium recently. For the U.S., this would involve revaluing the government's 261 million troy ounces in gold reserves, the largest gold reserves globally, from a statutory price of $42.22 to the current market prices, which stand around 3,300. So again, I don't know the full mechanism of what would happen. They've talked about this now. Other people are talking about it. You have financial sharpies in there at Treasury now and in this administration. So I don't put anything past them. Uh, you know, and then you have Trump making some kind of comments, not necessarily around this, but around tariffs and some of this stuff that if he create this money or get his hands on this money so he can spend it, quote, the way he wants to. And again, they were always talking about doing this sovereign wealth fund. I don't know how you can have a sovereign wealth fund when you have current account deficits and all these other things, but that's beside the point. But that would be something that would be interesting. One of the things Trump is in his administration has a lot of cryptocurrency folks in it, people that are biased towards being positive around, or at least agnostic to cryptocurrencies. And so, what if you were able to revalue gold and say, well, we want to diversify the U.S. government's assets or something, and say we're going to put this $1 trillion of after we revalued gold and buy Bitcoin. What would that do to the price of Bitcoin? So I put nothing past them at this point because There's going to be all kinds of shenanigans and chicanery going forward. This is what happens when you are irresponsible with your budget for 40, 50 years. But I don't have any particular insight into what they're going to do, if they're going to do it, what the repercussions of it would be. So we'll have to wait and see, but it's definitely worth following. This wasn't, like I said, some blogger or some, you know, conspiracy person on the internet. This is actually came out from the Federal Reserve. They published this. So they weren't saying they were going to do it, but they just floating the trial balloon to see, I think, hey, some people are talking about this, and then see what if there's any editorials or they get any, traction with it before they move forward. I think they probably will do something like this because the way they look at it's free money, right? So, um, but we'll have to wait and see what happens. Regardless, I think the precious metals bull market continues. So I wanted to talk about this. Siemens Energy orders hit record 136 billion euros on enormous data center demand. German maker of gas turbines says rapsius need for electricity to power AI boom drive sales. I still think that I don't know what the outcome of this AI investment is going to be, but the electricity demands are out of control. And again, we've seen this from GE Verona. We've seen this now from Siemens. I'm sure if I went and looked at Mitsubishi's orders, it would probably be something similar. Um, yeah. And so gas turbines, natural gas pipelines, the whole build out, quantum services company like that, Eaton, if they're worth watching and listening to. Would I go out and buy them now? A lot of these stocks have already moved, but definitely worth listening to conference calls to get, a view of what's going on in this. I think it's all gangbusters from what I've been able to discern to this point. So I wanted to put this here, the slide, nuclear power makes it into the McPaper. I call the USA Today McPaper because it's like a McDonald's meal. It's, that's kind of how that USA Today is. But it's what I'm trying to get at here. It's becoming mainstream now. Okay. And there was a positive article, and that's what we've mainstreamed now, nuclear power. We went, the zeitgeist has completely shifted from anti-nuclear, green, now we're everybody's pro-nuclear. This happened in the span of like just two years. It's amazing. Exactly what we forecasted would happen, and it has happened now. And so now nuclear power is now a growth industry, another industry that has been completely underinvested in for almost two generations, 40 years, and now they're going to try to ramp it up. Well, guess what? There's going to be bottlenecks all over the place. And when you have bottlenecks, when you have government throwing money at things, there's going to be opportunities for speculators like us. And so, what does this say? I mean, it's nothing new here. Why I call it the McPaper. It's just vanilla. The new Trump administration is pushing for both expansion of existing nuclear power plants and the development of small scale reactors that are faster and cheaper to build. Advocates say new nuclear generating capacity is necessary in large part to meet the growing demands of artificial intelligence computing. Yeah, we all know that. Although nuclear power is a key provider of always on, quote, base load electricity for the United States, it has for decades been largely relegated to also ran category of generation as climate change concerns drove heavy investments in wind and solar. Well, that's not the only thing that drove it. A bunch of subsidies did too. But anyway, the average age of existing nuclear power plants is 42 years, according to the Department of Energy. Again, building out nuclear power like I would like to do it, like I've outlined in the past, could completely change the U.S. economy, could completely revolutionize the U.S. economy, could put tens of thousands of people to work in high paying construction jobs, STEM jobs, engineering jobs, supply chain, forcing these companies to keep their supply chain here could help us emerge as a real player in the nuclear power industry. I've said it before, build 1,000 megawatt reactors in 10 years. Have Trump come out and make a speech like Kennedy did for the space program and devote the entire forces of government and the private sector for a public private partnership to to do this. And it would be the spillover effects again would be similar to the space program, or more probably akin to the build out of the interstate highway system. So here's another announcement. Kazakhstan, which of course is the largest producer of uranium in the world, now is launching construction of its first nuclear power plant. This is very interesting because, again, uranium and nuclear power is one of the most politicized industries and energy sources in the world, if not the most. Kazakhstan is in the orbit of the Russian Federation, and well, we know what the geopolitical situation is vis-a-vis uh, the Atlanticist hegemon and the global South and East, aka BRICS countries. But anyways, Kazakhstan now is going to, build a nuclear power plant. Well, Ross Adams going to build it, but anyway, Kazakhstan has officially launched the construction of its first nuclear power plant, marking a significant milestone in the country's long-term energy strategy. The groundbreaking ceremony was held on Friday in the Almaty region in the south of the country. The project is being led by a consortium headed by Ross Adam, Russia's state nuclear energy corporation. The facility will be located near the village of Ulkan on the shores of Lake Balkhash, 400 kilometers from Almaty, Kazakhstan's largest city. The plant will feature two reactors with a combined capacity of 2.4 gigawatts by 2035 and is expected to meet a substantial share of the country's future demand. According to the Atomic Energy Agency of the Republic of Kazakhstan, the total investment in this project is estimated $14 to $15 billion. An additional $1 billion has been allocated for the development of social infrastructure in the surrounding region. So we're just, again, 2.4 megawatts, that's 2,400 or gigawatts, 2,400 megawatts, that's about another million and a 1.5 million pounds a year in demand. And if you're going to start these reactors up, you have to put three times, right? So 5 million pounds of additional demand just to start the thing up and run it the first year. Again, where does the uranium come from? This one piece of news doesn't tip the balance, but again, it's one brick in the wall of future demand. Where is the supply? Again, where is the supply? Do you think Kazakhstan might stockpile uranium for its own uses, and that uranium would come off the market? Possibly. Platinum crunch comes to a head as US and China snap up metal. This is just part of the precious metal bull market. All precious metals are basically have broken out to the upside. A years long supply crunch in platinum has come to a head, with banks scrambling for dwindling stocks in London as buyers in China and the US hoover up much of the available metal. The market tightness has made platinum one of the best performing commodities this year and fueled sky high borrowing costs for the precious metal. Tariff fears have funneled large volumes to U.S. warehouses, while Chinese imports continue to exceed estimated domestic consumption. China scooped up a record 1.2 billion ounces in the second quarter. The world's largest consumer imports most of its metal, but those shipments have been consistently higher than estimated domestic demand, according to data from Standard Charter. So again, and here you just have a limited amount of vehicles that you can take advantage. There's only like three or four publicly traded, legitimate platinum producers, platinum group metal producers. Yes, you can get into some juniors and things like that, but again, I think platinum is really going to run because historically it's traded slightly above the gold price, and it's basically with gold at 3,400, platinum's at 1,300. I mean, it could three bag, just the metal price could three bag from here. And of course, I believe all these metal prices are going higher over time. Again, lack of investment is going to lead. I mean, lack of investment for many, many years is now going to catch up. Again, 40% of your platinum group metals come from, or platinum comes from South Africa. I mean, if you are a user of platinum and this is your, this is one of the main suppliers in the world, the other one is main supplier is Russia. This is not good. And so, it's not like you can just click your heels, snap your fingers, and a new platinum group metals mine comes online. This is, intensive amount of work, a lot of capital, and a lot of time, and it just has not been happening. We see this over and over and over in this resource sector, from commodity to commodity, the same story. And so that's why I think this next super cycle is going to be supply driven. It's not going to take that much more demand to kick this off and cause shortages and cause price hikes because the supply just doesn't exist in many cases. Here's an interesting chart, shows data center construction versus office construction. You can see when ChatGPT was launched, how basically U.S. data center construction has went up at 45-degree angle. And you see, it's interesting to watch how office construction is coming down. This makes sense because I'm telling you right now, I'm going to reiterate this. I think AI is just going to come through and massacre the white collar workforce. I don't know how exactly, but it's starting to happen already. And, if you're in data analysis, if you're in accounting, if you're a lawyer, even in the medical field, it's unbelievable what it can do already. I use it all the time for various things, and it is unbelievable what it can do. I don't even fully utilize it. Okay. And it's just going to get better and better. Now, I don't know if this is a dangerous thing down the line, but I'm just telling you what's going to happen. And again, I'm going to reiterate what I said before. These companies are going to just lay people off. This is going to cause at some point, in my view, a Luddite reaction from the workforce, because people are going to be like, now what am I supposed to do? Okay, become a plumber. I was working in an office. I mean, what am I supposed to do? Get a janitor's job? Well, that's fine until, the humanoid robots become sophisticated enough to take even those jobs. So this desire by the tech world to push this in some cases is good, but in other cases, what's it going to do? It's unknowable right now. And it remains to be seen. And I think that as long as you live in countries with democratic process, people are going to people are going to vote, And so what does that mean? Okay. Vis-a-vis technology and versus human beings, and it's unknowable right now, but this is why I think you have to be an asset owner. You must own assets. If you're just a wage slave and you just think things are going to be the same forever, I've said this before, the amount of volatility and shifting or a change that's going to happen is going to accelerate, and it's going to affect the entire world politically, economically, socially, uh, militarily, the whole thing. And things, you have the ground shifting, and most people don't even see it. They're not even conceptualizing it. They just have so much recency bias and 6-foot sphere syndrome where, hey, I don't know what's going on. I'm just here, you know. Yesterday was fine. Today seemed to be okay. So tomorrow will be fine. Well, you got to think a little bit further out. And if you don't own assets that you can capitalize, and that might not even save you. You're going to have to be very nimble going forward, I think, to make headway in this new world that's coming. So here's a big opportunity, right? This has been in the news, but I'm talking about it now again. China is choking supply of critical minerals to Western defense companies. Beijing's tightened controls are a sign of the leverage it has over the U.S. military supply chain. Of course. We're over here saber rattling. The previous administration, the chief of naval operations, was telling the Navy to prepare for a war with China in 2027. Why in the heck would China, which produces the majority of rare earth metals in the world, a lot of critical metals, not necessarily even produces them, but refines them, uh, they have a lot of this capacity. Why would they sell critical minerals that the United States military needs to build weapons so that they can be used against them? That makes no sense. And so this is again an opportunity. Why? Because we've seen what has happened with MP materials where the DoD, the federal government, the Trump administration recognized this, and they're taking a 15% stake in this rare earth company. I believe it's out in Nevada. Anyways, title of the slide, U.S. Defense Department takes a stake in a rare earth company. DoD is taking a 15% 50% stake in MP Materials and committing to spending billions investing in the company and purchasing its output in order to undercut China's dominance of rare earth magnets needed in the manufacture of weapon systems. DoD is guaranteeing a price floor for rare earth minerals and magnets so that the company is protected if China floods the market with rare earth minerals, thereby lowering global prices. The government is also guaranteeing that all magnets produced at the company's new magnet facility will be purchased either by the government or commercial customers. It's really a travesty what the government in the U.S. has done. This the total abdication of any forward thinking, planning, uh, selling out to these stupid environmentalists and green initiatives. We've totally compromised our energy, military status, all of these things. We have tremendous resources here in the US. I talked about this in one of the newsletters, paid newsletters I wrote a few months ago, of the trillions and trillions of dollars of mineral wealth right here in the US that's locked up and we can't exploit. Now, to, to the Trump administration's credit, and even the Biden administration in the last year of their administration, or year and a half, they started recognizing this and started making moves towards this. But it's going to require basically industrial policy, kind of in the Soviet way, where they're going to say, okay, we're going to invest billions of dollars in this, guarantee that you can make money doing it, guarantee you a market for your product so that we can get these things. We can't be I don't think I'm not going to get into the weeds, but the thinking I'm sure at DOD and in the administration and in the think tanks is how are you going to maintain a hegemon? How are you going to be a superpower with these rising superpowers in the global south and east if you can't even produce the critical minerals you need for your so-called vaunted military that keeps the sea lanes open? Does that make any sense? And so again, what's the opportunity? Well, we know that the U.S. government's going to throw billions and billions of dollars at this stuff. So the idea is, okay, well, MP Minerals got their cash, got their deal. Who else, is going to be receiving that kind of cash? What other critical minerals are on the list? Where are we going to open up mining? What are the companies that are going to benefit from that? That's kind of a research project that one could do to kind of front run this. This is going to happen. There's going to be billions of dollars spent on this. Okay. I'm not saying I agree with, central government planning and industrial policy, but it doesn't matter what I think. What's going to happen? It's going to happen because, you can't rely on your primary adversary for supremacy as the supplier of your critical mineral for weapon systems. That's stupid. It's not going to happen. And so, again, it's the same thing in uranium. The stupidity and the lack of foresight to realize that the United States gets 20% of its baseload electricity from nuclear power and then letting the nuclear power fuel cycle atrophy in the US. That just makes no sense. And now, you're in a situation where 40% of the enrichment in the world's done by Russia, the people that you're trying to sanction and, constantly call bad guys. And so you've done nothing here. Now, I think they're making moves to solve these things, but again, they take more than a year. It's going to take years and billions of dollars because no investment was made. Again, you can build a facility for enrichment. Who's going to work there? There's no trade school. You can say, well, yeah, there's some guys, 100 people a year coming out of this school that know how to do enrichment. No, you have to hire people. That takes time. Then they have to be trained. All of these things, and then you can get them in there. And then there's ramp up. It takes time. It takes time and a lot of money. And so these are opportunities in my mind to determine where can we take advantage of that. That's what speculating is about. Okay, guys, I know it's a little late. Again, I apologize. We had internet problems. I ran through the slide deck pretty quick. Again, the reality check will start next week, probably early next week, Monday or Tuesday. We'll kick that off, and I'll let you know where that's at if you are so inclined to want to listen to that and get that going again. All right, guys, I appreciate you. Thanks a lot. And please keep supporting the channel. It means a lot. It's really helping us grow. And we'll talk to you next week.